I hope that you've been enjoying all the superb content in this trading festival. So I'm going to share with you about using factors, okay, to improve your stock picking accuracy as well as your returns. All right. Introduction of myself. I'm Alvin, the CEO of Dr. Wealth. So I've invested in the markets for over 10 years, been through the last financial crisis that was 2008. It was a little bit different from what we are experiencing now in terms of the bull run. I still remember, in those days, Singapore and Hong Kong market were very hot, and US was actually lackluster. So it seems like, it's like a reverse at this point in time. But, regardless of what kind of markets out there, there are always opportunities, okay? So I hope that, using some of these factors, you are able to fish them out and ring fence that kind of opportunities faster and easier and more convenient for yourself. So I've written books like The Secrets of Singapore Trading Gurus as well as the Singapore Permanent Portfolio. But I'm going to share today are not written in the books that I have authored, okay? Because factors is somewhere in between. It's not as short term as trading, right? But it's not as hands-free as building a portfolio ETFs. So it's somewhere in between. But I do think that some people who use both fundamental analysis and technical analysis, and factors can be a very good tool even for traders. Okay, for you to generate ideas. All right. Then you use your technical indicators to go in. And in fact, one of the factors is a trading kind of indicator, which I'll share a bit more later. Okay. So what are factors? I keep talking about factors, right? So factors is like the cost of investment return, or is the drivers of investment returns. Okay. So we know that, cause and effect, right? You must have a driver to create a particular effect, certain behavior, right? Then you get results. Factors is the same thing, okay? Basically, if you look for stocks with a certain characteristics known as factors, your chances of getting investment returns, a higher investment returns, will go up. But it is not confirmed that you use factors, your investment will go up. It's just a statistics, okay? Where your sample size is big enough, the average returns will be higher, right? When we say average, it means that the stocks in the entire group, right? Some of them may go up more, some of them may go up less, some of them may even lose money. But overall, as an average returns, when you use factors, is higher than if you do not use any factors. Okay, so I hope that clears the air and make it simpler for you to understand. Okay, and let me just go on first. All right. So anyway, you have any questions, just type in the comment box. I can address them at appropriate juncture. Okay. So I want to take this opportunity to share a little bit about this history of factors. And I will start my story as in 1934. Okay, don't worry, I'll fast forward the story. Okay, we're not going to like go year by year until 2021. I'll fast forward the story, just a few slides. The story started in 1934 because of this book called Security Analysis. And some of you may have heard of this guy called Benjamin Graham. And he's made famous because of Warren Buffett. Warren Buffett has always named him as his teacher, right, in investing, the very first teacher. And indeed, he is very influential to a group of investors. And until today, his philosophy are still practiced by a lot of professionals, right, and retail investors, traders alike. And this book he authored was together with David Dodd. Okay, both of them wrote this book. And this book was originally used as a textbook for the module in Columbia School of Business, right, with the same name, Security Analysis. And this was the course that Buffett attended, which Benjamin Graham was teaching. Okay, and it was later on that they coined him this title, Father of Value Investing, right? They say, oh, in fact, Benjamin Graham has never used this term value investing. It was after a certain a number of years that people realized that, oh, this is one way or a very unique approach towards picking stocks. And then they attribute that kind of concept to Benjamin Graham because he has this security analysis book who talk about this concept in detail. Okay, so he is the father of value investing, right? And fast forward 50 years later, 1984, it was the 50th anniversary of that book, Security Analysis. And Warren Buffett being the model student, right, of that class, of that generation, came out and gave this speech. And the speech was titled The Super Investors of Graham and Dottsville. Okay. So he came out with this speech, and basically he was trying to counter the prevailing thought from the academics, where if you heard of the efficient market hypothesis, right, or EMH, basically it sounds something like this, right? It's very hard for you to beat the market. Fund managers have tried, most of them don't beat the market. And since it's so difficult, why not you just buy a index ETF, right, or index fund? Basically, you just buy the entire market, so the risk of underperforming market is almost non-existent. Okay. And Buffett, of course, doesn't believe in that because his entire career or his entire fund management business is built on the premise that he's able to do better than what you can get from the market. And he has performed so well. All right. And then he has to come up with a counter argument. And that was why he chose this title. And Graham and Dottsville is referring to the two authors of security analysis. Okay, basically, he wanted to showcase the disciples of Graham and show that they had very successful results. Okay, and it is doable because they were following a similar philosophy, right, when it comes to investing. So it cannot be just luck that they beat the index, and they also prove that they can beat the index consistently over a long period of time. Okay, so he quoted some guys like Walter Schloss. At that point in time in 1984, he managed money for 28 years, right, with over 20% per annum. Tom Knapp, 16 years, 20%. Bill Ruin, 14 years, 18%. And Warren Buffett, 12 years, almost 30%. Of course, it's best in class. You get to speak as a valedictorian kind of status. Okay. So then there were more to this, right? There were more longer list than what was presented over here. And that made his point. Okay. And let's fast forward again, 1992, right? And this is an important guy, Eugene Fama, because he's the guy who came out with the EMH theory hypothesis, right? And then he got the Nobel Prize for that, a joint Nobel Prize with two other economists on this topic. And so together with Kenneth French, which is his research assistant, then they were saying that, oh, since value investors say you're very good, right? Let's do an academic exercise and do a back test, a solid back test, and see whether there is really a different return profile when you use value. All right, so that's what they wanted to try. And they documented it in this paper. This is the title, The Cross-Section of Expected Stock Return. If you want to read it, you can go and find it. I think because it's over 20 years, they actually have free versions around. But I don't think it's necessary, okay, to read it because it's very, very difficult to read. As you know, research paper is full of jargons, and the English is so Queen's English style, right? It's so hard to comprehend. But if you can't sleep, you can definitely use this as an antidote. Okay, yeah, it's very boring. That was in 1992, right? So I would say that 1992 is really the official year that this factor investing has started. Okay, it actually originated from this research paper, and by these two guys, Fama and French, right? They popularized this factor investing, and this eventually the ETF market caught on, right? So sometimes you hear ETF, right? They say that this is a smart beta ETF, right? Smart beta. You hear this term. Basically, it also means that it's using factors, right? It's using factors. And Pharma is actually advising the dimensional fund advisors, right? The DFA, also doing all these factors selection of securities, right, for the funds. Okay, so it is really getting more and more popular. You will see more and more financial products that are created that's based on factors. So it is good for you to really understand why this is preferred and how it can help you to improve your investment returns. Okay, and I will just summarize the research paper for you, so spare you the agony to read the very boring and difficult to understand research paper. Right, and basically they need to define what is value first, right? To prove or disprove whether value works, they need to define what is value first, and they went to use a very standard value metric called price to book values metric. Okay, basically you divide the price by book value. If this ratio is low, that means it's undervalued. If this ratio is high, that means it's overvalued. Okay, it's a very classic value strategy, value metric. Although value investing use more than just price to book, right? It can be even price to earnings, price to free cash flow, dividend yield. There are a lot of different kind of value metrics that are out there, but they chose the most classic one, and that was price to book value. And what they did was that they went to crunch the number for all the stocks in the universe just based on this one metric. And then with this number, every stock has this number, right? This ratio, and they will rank from the most expensive to cheapest, right? Cheapest means the ratio is the lowest. Okay, and then they track the performance over time, right, to see which group have a higher return compared to others, right? And what they have found is that um, the most expensive group, right, the return was about 0.64% per month, okay, over a period of 20 over years of study at the point in time. And then the highest group, which is the cheapest group, okay, sorry, they reverse the price to book value, okay, so that's why it's low and high, but the principle is still the same. So in the cheapest group, right, the returns actually goes up to 1.63% per month, okay. So in that validation or invalidation of value, okay, what happened was that they prove value works. Okay, the cheaper you buy, as you can see, right, the returns goes up. Okay, right, the cheaper group returns go up. And if you compare, the most expensive group is 0.64%, and the highest the cheapest group gives you 1.63%. So it's almost a 3 times difference in performance, right? So in that way, somehow value was proven to work. So buying cheaper stocks gives you higher returns. Although it sounds like, duh, do you need a professor to go and really do this check, right? It's intuitively, okay. But the funny thing is that a lot of intuitive things in finance may not work, okay. And there are thousands and thousands of financial metrics out there, investment metrics out there. Which one do you know what to use, right? And you don't even know whether you're using one that is effective, or is it just a placebo metric? You just feel good to use, but it actually has no use. And it's only using factors, then you will know with more certainty that it's backed by some science. They have done some testing, and real world results have proven that this metric work. Okay, so that is the significance of value itself, or no, significance of factor itself, right? Factors is more than value. Okay, same thing they did for size of the company, right? By market cap. Bigger company, higher market cap, smaller company, smaller market cap, right? And then they also map out their returns. You also found that the smaller company gives higher returns than the bigger company. Okay, just that the difference is lower compared to value, right? But still, the size factor exists to a certain extent. Okay. And they, even in that paper, they went to combine both. What if you buy the smallest and the cheapest? What happens to your returns? In fact, what they found was that, right, just to orientate you a little bit, okay, so this is the most expensive group, okay, and this is the cheapest group. This is the smallest companies, and this is the largest in the vertical axis, right? So which means the thing that I circle over here is the cheapest and the smallest. Right. So what this table is trying to show is the monthly average returns of all these groups. Okay. And what they found is that if you buy the smallest and the cheapest group, you get the highest return compared to any other kinds of combination. Right. So some of these factors can be combined together. Some may not be able to combine because some of the factors may be contradicting each other. Later you'll know why. Okay, so these were the first two factors that were being discovered in 1992, and that spearheaded the entire factor investing research until today. All right. One thing to note, you have to be careful, is that there are many factors out there. Okay, a lot of researchers then came out because this became very popular, right? A lot of researchers started to pour their time and effort in this factor research, trying to find the holy grail. But sadly to say, majority of the factors are bullshit ones. Okay, there are only a few key ones that you need to know. Value, size are two of them, right? There are more to come. Okay. So how do you then find these value and size factors? I wanted to do some demonstration. All right, what you can do is that if you go to SGX website, they have a screener. You can actually screen for these factors. Okay, you can actually screen for these two factors. All right. Size is easy to locate because it's just purely market cap. Okay. So if you want small, you just scroll it down to a smaller number. Okay. I'll do a short demo subsequently. All right. And then if you want to buy value, okay, as I said, value can exist in many forms. The most classic one is price to book. Right, PE ratio is also pretty classic, right? I think most of you know this ratio. Dividend yield is another. Price to cash flow is also another that's possible, right? So value can have many kinds of variation, right? Not just price to book value, right? Maybe I just do a little bit of demonstration over here. Okay, just give me a while. I'm going to exit this screen and I'm going to share with you. Okay, the screener, right? You should be able to see the screener. Okay, so as I said, if you want to find small cap, you just click this box. Okay, they are to begin with, there are about 700 stocks in SGX. Okay, so you click on this market cap, you reduce this number. As you reduce this number, you can see the number of stocks actually goes down, right? So the more small, the lower you go, it becomes smaller, right? So maybe we just put around, I don't know, maybe 500 million. Okay, 500 million actually is a lot of stocks. Okay, but don't worry, you can add in the value factor as well. Okay, so maybe you put in the price to book, right? Maybe you put it less than 1. Okay, and maybe some of you like some yield, then you can click on the yield. Okay, maybe you want minimum how many percent yield, maybe 3% yield, right, or 4% yield. It's possible. Okay, then left with about 50 stocks. All right, then there will be your screen results. Okay, that's where you can look through, right? At least the list is reduced from 700 to 50, and these are based on value and size factors. That means picking from this pool gives you some statistical advantage. Okay, statistical advantage. Yeah. So by right, you should diversify to a group of stocks, not just pick one and then wow, you hope that you jackpot. Okay, so it does take some sample size, minimum sample size to begin with. And what's the number? I think given a diversified portfolio is at least 15. Okay, at least 15. But not too many. Okay, because if it's too many, might as well you buy ETF, right? If you like buy 50, 100 stocks, then the factors effect may if you diversify too much, all right. Yes, you may go close to the average. But I think that it will be hard to manage as an individual investor, okay, because you have limited time on that, right? So I think that if you want to pick stocks, then it always makes sense to have sufficient diversification, but not too much. Okay, let me go back to my slides. Where's my slides? Okay, just give me a while. Okay, getting my slides ready. Okay, so just go and play around. You can do a combination of it if you want to, right? So those are the value and size factors. Okay. Then 1 year later, another group of researchers, Jagadesh and Titman, found another factor called the momentum factor. Okay, those who do trend following will understand this very well, right? Trend following essentially is tapping on the momentum factor. Okay, so besides the value investors, there's also another group of very famous traders known as the trend followers, right? That means they don't believe in buying undervalued stocks, okay, because undervalued stocks can stay undervalued for a long time. They believe in buying stocks that have already gone up. Okay, so you can see then, it's very the beliefs are very different, right? Value versus momentum. Okay, but that said, right, there are also some people who combine value and momentum together. That means they identify the undervalued stocks first. Okay, then they wait for them to move to show some momentum, then they go in. Okay, they'll be later, but at least they don't need to wait so long, right? So a lot of traders prefer to do this, and especially in the last few years, if you do trend following on the tech stocks or even like the how to say the glove stocks in Singapore that did very well last year, you'll be able to get in, right? Or even iFast, okay, it's been trending very strongly, okay, for the past few months, right? If you use value, you'll never be able to go in, but if you use a momentum factor, there will be some points that you can actually get in, right? Because of all these very, very strongly trending stocks. Just as you know that, when IFAS hit $2, cannot be lah. Then it hit $3, cannot be lah. I think it's too high. Then you go to 4, 5, and even $6. Okay, so that's where trend following or momentum factor thrives, right? That's where the moment it will shine very well, while value will just keep waiting for it to crash. Okay, so each factor has its own use at different point in time as well. Okay, so the paper is this returns to buying winners and selling losers. All right, so if you are keen to read about it, you can go into more detail. Basically, this was the results in their research paper. All right, and what they did was that they found that basically there's no fundamental to look at one. It's really just price-based return, right? The stocks that trend the strongest or the stocks that return the highest in the past 1 year, okay, will give you will go up even more than a stock that didn't go up that much, right? So that's the very funny thing. Okay, and that's why the factor is named as momentum. Okay, what goes up even more, right? What goes up little, right? So there is some past pattern that you can exploit. Okay, and that is where this momentum factor kicks in, right? So basically, if you buy the winners, you have higher return than if you buy the losers, right? More than 2 times, right? More than 2 times the return differences. Okay, so it's quite stark, the difference. And how do you use momentum factor? You will basically you just need price base, right? So on a SGX screener, you identify anything that is very price based, right? So I'll do a demo again, okay, on this. So basically you can see it's all the price change kind of indicator. Let me just show you once more, right? Let me reset all this. Reset. Okay, and you can see over here there's a 4-week percent price change or 13-week percent price change, 26-week and 52-week. The most classic one is the 52-week, which represents a year, right? Usually that is the classic one. Depends on your trading time frame, right? If you want to just trade a shorter time frame, then it makes sense for you to use the shorter period. Okay, to use a shorter period. All right. Otherwise, the most standard one is 52 weeks. Okay, and you want the price change to be high, right? Maybe you identify the top 50. I don't know. Oh, that's too much. Okay, maybe around here, top 59. So these are the stocks that return the most in the last 1 year. All right, these are the stocks that return the most in the last 1 year, and you can layer on your technical charts to look for points of entry to ride the momentum. Okay, so this is one of the ways to use the momentum factor. Okay, right? Let's carry on. I hope so far so good. Okay, if you guys have any questions, can just type in. Okay, right. Let me just continue. Okay. Right. So let's move on to the fourth factor they're going to share with you today. It is the more recent factor, profitability factor. Okay, so this is like more for investors, I would say. You hear people talk about, oh, I like very profitable companies, very high quality companies. I like growth investing, all this kind, right? Then this is the factor to use. Okay, profitability factor. It was discovered by Robert Novi-Marx in this paper, The Other Side of Value. Okay, so this is the other factor, and basically what he found is that it's not just value that delivers higher returns. Okay, there's another group of stocks, right, that is never undervalued or very hard to be undervalued. They are always trading like a fair price or premium. Okay, but somehow their returns is comparable to value when they don't have any value characteristic, right? They are not low price to book, they are not low PE, they look expensive, but they continue to become more expensive, right? The growth rate, because the growth rate is there, investors like it. So the quality of the business is there. So there's longevity in this kind of business. They become much bigger in the future compared to today, right? So if you are that kind of growth investor, high quality company investor, then this is the factor to use, profitability. Okay. So again, proven, right? I think this is not difficult to understand. More higher profitability stocks give you higher returns. Okay, I think this one nobody wants to argue, right? Of course, maybe some people will say that, oh, there are some stocks that lose money, but still go out a lot. Okay, uh, uh, but the factor, as I said, it's not just the profitability factor. Okay, I will lump it under the quality factor, right? And quality sometimes also includes growth rate, right? Sometimes a company may not be generating a lot of profits, but because the growth rate is very high, they are reinvesting back a lot of their profits into the business to grow it faster. So that's why the profit is low, but the growth rate is high. And investors also are okay, right, to see this because they'll be a lot bigger in the future compared to what they are today. All right, so that's the profitability factor. And you can also use something similar, right? Because every factor, right, has different kind of metrics. Okay. So in this case, on SGX Screener, you can see like net profit margin and ROE percentage. Okay, so ROE is also another very common kind of metric that people like to use. All right, so these are close to what profitability factor is. Okay, technically by right, you should use higher up the income statement. That means net profit usually is a dirtier number because you can have one-off kind of gains, or you can have a valuation gains. Okay, so by right, if you use higher up like operating profits will be better because they are closely related to the business, whereas net profit can include a lot of things outside of the operating business which skew a little bit of the results, right? Just need to take note of that. Okay, as a from a fundamental analysis perspective. Let me also show you again on the screen, right? Okay, you should be able to see here. Let's then now do an example. Okay, I don't prefer net profit margin that much. Okay, as I say, because some years if they invest in the business a bit more, then their net profit margin will go down. But it's not necessarily a bad thing, right? Maybe of these two, I'll prefer the ROE. Okay, and ROE, of course, you want it to be higher, lah, right? You want it to be higher. Okay, maybe you end up with about 50 stocks or so, right? Then you can see from here. Right, so these are the stocks with high ROE. Okay, so those of you who like quality company, usually screening with this will get you closer to the stocks that you want to buy. Right? So that's how you use the factors. Okay, let's carry on. Right, I'll answer your questions later. Just keep them coming. No worries. Okay. Another thing I want to warn you is that don't think that wow, I found one factor. Alvin taught me the factors. I like this factor a lot. I like the momentum factor. I like the growth, profitability factor. I like the value factor. Okay. The thing is that there's no one factor that does well every year, right? Every year somehow it's like a wheel of fortune. The best performing factor always changes. Okay, so you can see sometimes it's small cap, sometimes it's momentum, sometimes it's value, right? High dividend is also value, small cap, value. Minimum volatility is more like high quality or closer to your profitability. Okay, sometimes momentum also have growth kind of element in it. So you can see that you won't know, right? Like what is the best factor for 2021 this year. Okay, I also don't know, right? So investing is difficult to guess who is the winner, like whether the market is going to crash this year. Nobody knows. Okay, the future is always uncertain. There are only some signs, but it doesn't tell you exactly what's going to happen. All right, same as factors. Then how do you then deal with this? Okay, so my suggestion is that you diversify into a few factors. Okay, so for me, I like value and profitability. So I combine both together. So when value don't do well, then profitability may do well. When if profitability don't do well, then value may do well, right? So they tends to be opposite in that sense, right? Then any one point in time, there is one factor that's performing. It pulls up the portfolio returns. Okay, so that is how you can take advantage of the factors by diversifying, right? So I know you guys have heard about diversifying different assets, right? You should have bonds, you have stocks. Okay, these are very common kind of diversification. You heard about diversification by time. That means don't go in at once. You dollar cost average over a period of time. right? So you can also diversify by factors, okay? Now, right, the different kind of stocks, okay? The stocks that pass value will look very different from the stocks that pass profitability. They will look very different from the stocks that pass momentum, for example. Okay, so by diversifying, it gives you a different variety of stocks. Okay, they may perform at different points in time, right? Instead of guessing which is going to be the best performer, all right? Okay, it's very hard to guess, right? So just diversify. Okay, so this is the summary. Okay, I'll answer more of your questions subsequently. All right, factors have proven to deliver higher returns, but not all the time. Okay, and that's why it's better to diversify a few of them. All right, have a couple of factors in your portfolio. Buy different kinds of stocks. Okay, that's the solution. Just remember we covered 4 kinds of factors: value, size, momentum, profitability. Okay, and usually value and size goes hand in hand together, because when you buy value, usually it comes with small size. Okay, so value is about buying cheap stocks, and there are many kind of metrics you can use. Classic one is price to book. Some people use price to earnings. Some people use price to free cash flow. Some people use dividend yield. Okay, none of them are perfect lah, right? So you can also use a variety if you want to. Then for company that are not making money, you can use price to sales. Even other metrics like EV, EBIT, the more advanced one, EBITDA, all these are also considered value metrics. All right. Small basically is just a market cap. Okay. Small market cap lah. These are the stocks that likely your funds will not invest in, because their fund size are too big for these companies. End up, they might just buy up the entire company and delist the company, and that's not their purpose, right? So they tend to be under the radar. Media may not report them that much. Analysts may not cover them that much. Okay, but you can see it as opportunity, because precisely they are less followed, right? Then their price may be less efficient, and then the chances of them being undervalued is higher. Okay, so that's the whole premise of the small neglected companies that most people don't look at. Okay, there are less money chasing after them, right? So less premium to pay for them. Momentum, we talked about momentum are usually just price-based kind of indicator. Okay, price-based. Okay, there's no fundamental to look at, no PE, no PB, blah, blah, blah. But that said, right, there are also some traders started to look at other things, right? Whether there's an improvement in revenue, okay? Whether there's an improvement in profitability, right? Whether there's a momentum, okay? So momentum can actually be used for fundamentals as well, just that it's rarely used, okay? Because it's difficult, right? It's difficult getting the data and the quality of data. So they end up doing more price-based one, which is the simplest, right? Any stock that goes up will go up even more. And this works on both directions, not just up. Any stock that goes down a lot will go down even more. So that is the entire momentum premise. Out of the 4, I would say that momentum is shorter term, right? Usually a few months. Okay, usually the momentum lasts a few months. Hardly it can last for years. Whereas for value, size, profitability, when you go in a position, usually it's for years. Okay, before you get the returns, right? For value, usually it's an event that unfold, a value unlocking event, right? That cause the share price to go up. For profitability, it takes time, right, for the growth to come in. Okay, growth doesn't come in one day, right? Growth comes in a couple of years. So only through that process, then people will start to see, oh wow, it's worth so much now. Let's go and buy. Okay, so that takes time. Whereas momentum, you need a lot of energy, you need a lot of capital rushing for the stock in order for it to be pushed up year and year after year, which is very hard. Okay, so usually that run out usually lasts maybe weeks or months the most, right? So momentum tend to be a shorter term kind of factor. That's why traders like them a lot. Okay, because they can go in and go out at a higher frequency, right? Whereas investors prefer the rest: value, size, profitability. And so profitability is about buying the highest quality business, right? So it can be your, like what you mentioned just now, ROE. I mentioned the gross profitability, okay, which is the GPA lah. GP, sorry, let me just rewrite. GP over total assets, all these kind. Some people use ROA, right? Because ROE give you different kind of numbers. One with leverage, one without leverage. Some will look at the gross margin. right? Yeah. Okay. All these kind of things. So I'll look at revenue growth. Okay, because it is a sign of quality, right? So there can be also a lot of different kind of metrics that you can use to determine profitability or quality of a business. Okay. Another thing I want to say is that all these factors, right? All these factors are quantitative. Quantitative. That means they're very numbers driven, right? But numbers can only tell you so much of the information about the company, right? So I always say like investing is like a jigsaw puzzle. You start with maybe a 1,000 pieces jigsaw puzzle. Okay, so you have to find information and piece the picture together. Okay, and the thing is that quantitative maybe give you half the picture, right? When you use the numbers. Okay, numbers are important, right? But it doesn't tell you the entire picture. Maybe you can complete the picture here, okay, but you still miss the other part of the picture. And that's where the qualitative analysis come in, where things cannot use number to explain, right? To finish the entire picture, so they a complete picture of the company or the stock, and you decide whether this is a good buy or not. Is this a sell or not? Okay, so it's about collecting information to make an informed decision about buy, hold, and sell actions. That is what investing or trading is all about. Okay, so to have a complete picture, I always believe that you must have both sides, quant and qualitative, right? I give you an example, right? Like if your spouse asks you, how much do you love me? Then you say, oh, 10 upon 10, right? That's the politically correct answer, by the way. But you know, how are you going to put a number to that? Okay, it's not possible, right? So some things are just cannot be measured by numbers. Okay, how much do you love your kid? How much do you love your mother? Right? How do you gonna put a number to it? Right? Or how do you evaluate a management? Okay, or this management is 10 over 10, this management is 7 over 10, right? But it's still very subjective. To another person, maybe it's 12 over 10. So where is that benchmark where you can really get a very clear quantitative value out of it? Right? So that's why certain information can never be explained by numbers. One, it can only explain by I don't know, subjective analysis, okay, if I may use that term. All right. So when you use factors, it is very heavy on the quant side. Okay, it's very heavy on the quant side, which means it is a starting point, but you should use other qualitative analysis, right? So if you're a fundamental analysis guy, okay, then you go evaluate my management, business model, all this kind of thing, right? If you are a technical analysis guy, then you say, oh, I'll lay on my charts, okay, additional indicators to see whether these are good entries or not. Okay, so just remember, factors are used as a starting point. It is not after you screen out or you look at the company, you just buy them. Okay, it's not that way. Usually it is a starting point. That said, then how come there are smart beta ETF, which are pure quant? Okay, even your index funds are all quant, right? It's just mathematical formula. Come out with the top 500 companies, top 30 companies, top 50 companies, then they set up the entire index, and then you just invest in index, and then you get good returns as well. Okay. Smart beta ETF as well, right? They have identified this factor, blah blah blah. Let's find all the stocks that pass this factor, and we buy all of them. Okay, so also can. Okay, also can, right? Although I say you should not go all quant. The reason is because they diversify a lot in the hundreds or even in the thousands. Like the DFA funds, right? I think it's over 10,000 stocks. Okay, so the thing is that the more quant you go, you need to diversify more, right? You need to diversify more. But as I said, for individual investor, usually you cannot manage so many stocks. Either you pay a lot of custodian fees or you pay a lot of commissions. It doesn't make sense for you to hold so many stocks, right? And if you have to hold less stocks, then you need to put in your qualitative analysis, okay? Because you won't have the statistical average returns, right? You will achieve that because you don't have enough sample size to support that. All right, so these are important considerations that you should have. Okay, let me just take time to answer some of your questions. Okay, so let me see. Right, I'll just take time to answer some of them. I'll start from the earlier ones. Okay. Okay. Hi, Alvin. Would you have any advice for the youngsters and millennials who constantly think that buffer and value investing style is irrelevant or even old-fashioned, especially given the upqueen exponential returns in tech, innovative, and disruptive growth stocks? Okay, that's a very good question because that's what is on everybody's mind, right? That, why go for all these value? Buffett has been underperforming, and then you have all these exciting tech stocks that's delivering very high returns. Why not just close your eye and buy them? Okay, so my answer is this, right? Actually, there's a few parts to it. Okay, there are a few answers. Right? Your question actually can be broken down into more questions. Let me just answer one aspect first. Why is Buffett returns coming down? Okay, it is not that he is lousy. Okay, I still believe that he is as sharp as he used to be. In fact, he's more experienced now compared to his younger days. The difference is because his capital has become too large, right? He's managing billions and billions and billions of dollars. When your capital grows bigger, right, naturally your percentage return will drop one. But even when his percentage return drop, right, the amount, let's say it's 10% of $50 billion, or $500 billion, is still more than someone, who make 100% of $100,000 capital, right? You know that it's different, okay? So then some people will start to think, oh, I made 100% last year, Warren Buffett made 10% last year, I'm 10 times better than Warren Buffett. Is that true or not? It's different because your level of problem is different from his, okay? Give you 50 billion or 10 billion to invest, right? Your returns will suck again. Okay, your percentage return will drop. So the context is different. I don't think you can just compare that way. The only way to compare percentage return is to compare with the same size for the same period, right? Then at least it's apple to apple comparison. You cannot compare apple to durian, right? Then you say that you see my apple grew faster than your durian. Okay, that context is very different. Okay, so I just want to make that point first, right? Then on the note that being irrelevant and compared to the more disruptive technology, okay, I have these slides to show you. All right, as you can see, right, every factor changes. Okay, so now the flavor is a lot of momentum, right? A lot of momentum for the past 2 years. Okay, a lot of momentum. That means whatever goes up even more, right? And that is exactly what you felt last year, especially after 2020 COVID-19 March period. The market just had staged a sudden rebound. The stocks that went up rebounded very fast, continue to get whacked even higher because a lot of capital were chasing after the same stocks. Okay, that fueled the momentum even further. Does momentum factor continue to reign next year, this year, 22-1, 22-2? I don't think so. Right? I don't think so. As you can see throughout the history, right? There's very little chance that a factor continue to dominate for a long period of time. Okay. So for all you know, 2021 is not a good year for US tech stocks. Okay. Right. And in fact, we already see that in the last 1 week, right? The sell down was also very fierce. Okay. And by momentum, what goes down even further. All right. So maybe the momentum works against the positive momentum in this year, right? Nobody knows. Okay. But I just want to say that you cannot just bet on there's this thing called recency bias lah. Okay, humans have a lot of biases, right? Recency bias, availability bias, right? We tend to weigh the recent performance a lot more than very logical kind of analysis, right? So if we see a lot of the tech companies doing well, we tend to emphasize that, we should buy tech companies because they've been doing very well. And this is the short-term recency bias that cause a lot of investors to chase after performance. Okay, so this leads to chasing of performance. At the tail end, okay, because remember, momentum doesn't last very long. Momentum by right lasts a few months. Okay, just that for last year, the second half of last year lasts very long. Okay, but not all stocks. Some stocks still faltered, right? So they tend to chase performance, and they make them go into a stock at a high point, maybe at the very last stage of the momentum before it collapses, and then they lose a lot of money. Like, people talk about the Wall Street bets kind of stocks, right? A lot of the people who jump into it were very late, and it is the early people who make money. The people at the end all lost money and lost big time, right? So that is the issue. Okay, don't chase performance. You need to really be intellectually honest with yourself, right? Whether you are falling into any of these biases. Okay, let me move on. The momentum study was up to 1989, still fully applicable and relevant today. Yes, okay. Momentum is still, last year momentum was the best factor, right? Last year momentum was the best factor. Okay, so it's still applicable today, right? You ask all those trend followers, they will tell you it's still applicable today. It's also applicable for derivatives. right? Whatever moves, whatever have a price. Hello, which stock research analysis is the best to follow? DBS, Philip, Capital, CIMB, any other? Just follow everybody. Anyway, it's free, right? You can have different viewpoints on the same stock. Okay, I think that is more important. Then nothing beats making your own assessment. Right? You can read other people's analysis, but you still need to make your own at the end of the day. Synthesize the information that you received. Okay. What if the indicators give us conflicting information? That's why you have to be careful about how you choose it. Okay, like for example, is very value and profitability factors, right, are not complementary. Usually they're opposite. High quality company is unlikely to sell you cheap, correct? And then cheap company are like unlikely high quality. Okay, so if you try to force feed these two together, you will not find anything to buy, and that is natural, right? That is natural. So you have to know what factors complement with each other. Like value and momentum still can, okay. Value and size will work hand in hand together. Momentum and profitability also can, all right. But profitability and value cannot. Okay. These are the some of the consideration, and momentum and size I think also a bit difficult, right? These are the ways you need to know what you're looking for. Are you looking for growth? Are you looking for value? Are you looking for dividends? Are you looking for short-term price movements? Right. So if you don't know what you want, then you don't know what indicators you use. Then you anyhow use the indicator, you get very confusing information. Then you become even more confused, right? So you need to figure out what kind of stocks do you want to invest in or you want to trade in. Okay. Where can I do the same selection criteria like provided SGS for US stocks? I think there are plenty of screeners out there. There are a lot of free ones. Just do a Google search. I think not difficult, right? Using a factor strategy, what stocks would you recommend for 2021? As I said, it depends on, it's not important what I buy, right? What I buy, but you cannot buy or you don't have the risk appetite to hold when it goes volatile, it's going to be detrimental to you, right? So I would say that um, um, you should know what you want to buy first. Okay, so maybe I just to answer your question. I do write some of these online, right, on Dr. Well, some of the ideas. Okay, I think the latest idea that I like would be for value factor, value and size factor, in Singapore would be Centurion, right? So I do have the stock. Okay, I'm not asking you to follow, but since you asked that question, right, and I think that for value, that looks like something that's interesting. How small a market cap is considered too small for a fund institution? It also depends on the fund institution. I would say there's no right answer. I would say sub 500 million are small, right? Market cap. Okay. Uh, for different market is different. Maybe for US, you can go and do a search. They have numbers. But for Singapore, I don't think there was an official number. I would still think below 500 million is small. Okay. Let me see. Did I miss or you did not mention that as consideration for stock picking? Um, you did not miss it, okay, because we are using factors, right? And in fact, some of the factors to pass, that should not be a high number to worry about. Okay, momentum factor definitely won't care about the debt, but if a stock pass value, right, likely the debt is not high. Okay, likely, because let's say you take price to book value, right? If you want a low price to book value, your book value has to be high. And if your book value is high, your equity has to be high. If your equity is high, your liabilities cannot be high. Okay, so there is some implicit relations, right? For value profitability, there is a chance that the debt may be high, right? But if it is so, depends on what kind of metric you use. If you use ROE, okay, the debt may be high, right? So that means the returns is really generated by leverage. But if you use ROA, okay, and you get a high ROA stock, the debt cannot be high. All right, the debt cannot be high. Okay, usually that's the case, right? So that's why people use ROE, ROA sometimes together. Then that debt consideration will be in there. Okay, right. Are we now in a tech bubble like in year 1999? I don't know, right? Because in 1999 I wasn't investing. Okay, the only last crisis I invested was 2007, 2008. So I can't tell you, right? Because I never lived through that period. Okay, yeah. Do you consider earnings date or ex-dividend date before buying the stock? Can you advise the best time to enter before or after earnings, for example? I don't play this kind of earnings or XD date, lah, right? Because by right, on the XD date, the share price will drop by the dividends, the amount of dividend received. So there isn't that gain or lost that much, right? And sometimes you do see the dividends or the share price jump up because there was a large dividend being distributed, right? That's primarily because of the good results and to price in for the eventual dividends to come in. Okay, so they go up first, then after they come back down, right? So, and anyway, it's very little money if you can find some efficiency there, but I think it's very hard game, right? So I won't bother. Okay, I don't have a particular timing on that kind of short-term evaluation. How do you see if momentum is related to trading volume of a stock? Look at your charts, okay? Especially if you see the price going up or going down on heavy volume, right? Usually the momentum strength is very high, okay? I'll just answer a bit faster because I only have 5 minutes left, right? I just want to I hope that I can answer all the questions. What do you see is the current situation, market bubble or investor trader bubble in a rising interest rate for US stocks? I do think that US is definitely more overvalued than anywhere else, right? Singapore has a lot of value. Okay, if you are dividend stocks, don't need to look anywhere. Singapore has the best dividend stocks. You have no dividend tax here. You can buy a US dividend stock, you get 30% dividend tax. Why you want to do that, right? And you get a foreign exchange risk that comes with it as well, right? Because of the printing of money, US dollar is not very strong. Okay, so you might have some forex loss as well. So I would say that depends on your investing style, lah, right? If it's like value factor, size factor, Singapore, the way I see it at this moment is the best market, okay, to look at, right? Because Singapore market hasn't really gone up. Okay, a lot of value to be found. What is your favorite chart technical indicator? Simple ones lah, like moving average, pivot levels. All right, so I do use some of this as a reference. Last time I used to like the Donchian channel, very good for momentum, right? For breakouts, but breakouts are less reliable. Okay, but once you catch on a real trend, you can ride very well. Okay, but accuracy tends to be lower. Again, there's no perfect technical indicator, depends on what you're looking for and your strategy, right? What keeps you excited about the current markets? Wow, I love this question. Okay, because I've never got this question before. I think I'm generally interested in markets. We have been doing this for a long time, many years, and I never get sick of it. So maybe a bit of addiction, right? So maybe I'm a stock market addict lah. I'm always excited lah. Okay, even if the market nothing, I'm also excited. Okay. May I explain again how to see the factor changes chart as displayed now? Okay, basically it just tell you that it's random, which factor outperform the others or the best return factor. Okay, the just to orientate you a little bit, right? The first row on the top is the best performing factor of that year. All right, the first row. Okay, that's all you need to know, right? And you can see that the top factor always changes. It's never consistent. Okay, so you cannot use 10-year series one. It's random, which is going to be the best factor. So that's why I suggest that you diversify. Okay, what are the criteria to look for in qualitative analysis? Okay, so a good question again. So it depends on what kind of stocks you're looking at. If it's like value, then I would think that what kind of catalyst can unlock the value of the stock, because if there isn't a catalyst, right, then the stock will remain undervalued. Okay, catalyst can be merger acquisition, earnings turnaround, sector recovery, all these kind of things. If it's growth, then the business model is very important, right? What is the competition like? Don't try to buy a growth stock in a very highly competitive industry. Usually the profits get competed away. You should only find those that are usually the market leader and still growing very fast. So they have a very validated model, and they must have some competitive advantage for them to gain the market share to become number one. Okay, so these are some of the qualitative analysis that I see, right? When to sell? Again, good question. When you make a mistake, okay, and you have to be honest about it. Most people, they don't sell when they know they even when they know they make a mistake, right? So they continue hopefully that they will rebound, but hardly it will happen. Okay, so if a mistake, sell it as fast as possible, right? Easy to say, very hard to do. If you want to for profits, okay, so for value stocks, usually I have a price target, right? Because I can calculate what's the fair value. Once the value stock rebound to the fair value, I will sell. And if it's a growth stock, I will just hold. I will just keep holding and holding until the business is not as good as before. Growth rate has slowed tremendously. Market has become more difficult because of competition, right? All these kind of things. Okay, so selling, I must say, is more difficult. Buying is easier. Is shares outstanding important? No, it's just a divider for the per share value or per share price. Okay, not important. Let me see. All right. Are these signs of market top or the saga that's happening in US? It's hard to say now. Things can go crazy for a long time now. Okay. Is it reasonable to buy Singapore stocks since it does not really move? As I said, uh, growth stocks maybe not so in Singapore, but value, dividend, all these are still very valid here. All right. Okay. Yeah, it's like for the last 1 week, right? You appreciate that you're in Singapore stocks and not US stocks. Okay, because you lost about money. Okay, thank you very much. I cannot finish all the questions. All right, thank you for entertaining me with your questions. I'll catch you another time. All right, all the best to your investment and trading. Thank you.
Thank you, Alvin, Dr. Wealth himself. Do check out his website and his posts. He does a lot of education, and his posts really are very interesting to read. He's got lots of great ideas, so do check them out. Thank you very much, Alvin, for that session. And ladies and gentlemen, we want to let you know that for the 4 p.m. session coming up, I'll be speaking to Binny Ong and Joey Choi, two very talented individuals who trade successfully for a living. And if you've ever wondered what it's like or what it takes to trade successfully or even make trading your full-time career, you definitely want to attend their session. Also, at 4 p.m. for the other English session, Alvin Vong from Equity Striker will be tackling the question, are growth stocks better than value stocks? That's the million-dollar question, isn't it? So click on the buttons at the top of the page or on the schedule to head to your preferred session